Well, I hear, speaking of NMHC,
Yeah.
so let's talk about some more apartment stuff. We
Yeah.
got the quarterly survey of apartment conditions. Quarterly, they take a survey of how everyone's feeling
Yeah. So
in the industry.
I wanted
Or I
to
don't want to jump ahead too far.
no, I think that this illustrates, this is the Groundhog Day, really the
Yeah.
numbers behind the Groundhog Day that I was kind of thinking of, and it's a real turning point from the end of Q3 2024 to
Yeah.
into basically Q1 2025. Interest rate optimism dwindled, and in the deep recesses of the human heart, where resides the common threads of investor sentiment, a more hesitant and melancholy chord has sounded. Current sentiment on the multifamily market is down. I got a little romantic there, but these feelings really touched me, and it is a little disappointing that things have gone down. We're basically at where we were in terms of overall sentiment, I guess. A little improved from January 2024, but not much different if you're comparing January 2025 to January 24, especially when it comes to market tightness, which is a product of our renters filling up apartments, and then their sales volume. It's a little bit better. So investors are buying slightly more, but not by a lot. Equity financing, the same picture. It's hard to get investor money, relatively a little bit better since last year. And then finally, debt financing is a little bit worse, it seems like, compared to January 2024.
Yeah, I mean, it's not surprising. I mean, to me, the market tightness. I mean, we're not doing as good as maybe we were, or sentiment isn't as good as July. But we also we should think about like where everyone's head was back in July and October. Really back in July, because October we were already getting a sense that. Obviously the presidential election hadn't happened, but rates started, 10-year Treasury started moving, with the idea of that maybe Trump is going to get elected, tariff business that we're going to talk about in a little bit, but it's tied to the debt financing. I mean, in July and October, there was a confident sense that the Federal Reserve would continue to lower the Fed funds rate, so we would have lower interest rates. The 10-year Treasury was sub 4. It was in the basically like 375 to 425 range. Now all of a sudden we're at, we got up to 477, and then we're closer to 4.5 today, or when I looked yesterday, and so the interest rate environment has changed considerably, and that affects sales, it affects volume, and it affects values. It affects refinances, it affects loan maturities. Individuals and owners who were hoping to transact this year, it affects the buyers. Because if you were wanting to buy, you need low interest rates to make the deal work. If you wanted to sell, you want to have lower interest rates so your buyer can pay you a price that makes sense for you and for them. If you've got a property that has a loan that's going to be maturing, or just a loan that you don't like, you'd like to refinance, well, you need rates to be favorable to be able to do that in a way so you're not having to bring money to the table when you actually close.
If you scroll down, you can see graphically how much things have fallen off, especially when it comes to debt and equity financing there after this. So market tightness and sales volume, that seems to be okay. Obviously, sales volume has fallen from the previous quarter, but the chart below this that talks about equity and debt financing, you really see a drop off from the previous quarter.
Yeah, I mean, it makes sense. The debt is available. I mean, lenders want to lend. It's just the interest rates are high. So it's not as though that that debt is tight, not necessarily on terms, but just on costs.
And that, to me, seems to be the biggest question that I was thinking about this week.
And equity is equity is changed from October, but it's basically back where it was kind of mid last year in 2024. Where look, if we can find a good deal, we'll do it. But it's hard right now. People are getting excited.
Compare that from a long period from October 2022 to October 2023 when it was down in the 20s or the teens, and now we're back up to the 40s, the 50s, which is basically even, it seems like. No, I think that the big question here is, there's the steep drop off. We got really optimistic, and now we're just really not doing too well. Globe Street poses this question. We'll talk about this in a little bit, but and so does Marcus and Millichap actually more directly, is the fact that people are adjusting to maybe the expectation of higher interest rates. And that fell out of the NMHC meeting and conversations that John Chang had with people talking about the multifamily market specifically, about how maybe, in the interest of actually transacting this year, they're willing to accept this idea that, rates are going to be maybe in the 4.5% range throughout the entire year. I think that could happen. I think there's now it's also intersecting with loan maturities.
Yeah, the dream is gone.
Yeah. So
I mean that's what I was getting, is that that dream of, hey, no, we're very confident the rates are going to be lower next year. That's what everyone was saying last year. Like we feel strongly the rates are going to be much better. We thought that too. We're like, most likely rates are going to be a little bit lower next year.
So
because inflation is still receding. Again, these tariffs haven't gone into effect, and we'll see what happens.
Yeah.
It's just more of the idea that there could be more inflation related to tariffs, which is a possibility, but it's not happening yet. If you look at the CPI print, if you strip housing out and you just look at the super core, we're kind of where we need to be.
Yeah.
And so
agreed.
we've talked about this in the last several weeks of how much is of the higher rates and even the Fed going on pause, which they did last week. How much of this is just overcorrecting a little bit for a concern of the unknown and for volatility?
Yeah, I completely agree. I think that there was some real strong signs of that inflation was kind of getting under control. The long-term trends were really positive, and even the jobs numbers didn't suggest that we would get close to like an overactive labor market like it used to. Jobs are down. Job growth is down from previous highs on the long term. And when you're talking about long-term trends, so it's not exactly like we're like battening down the hatches and keeping the door shut before inflation blows in. Like things are actually calmer outside than you think.